Welcome to a deep dive into the fascinating world of blockchain economics. Today, we're cutting through the noise to deliver the definitive Q2 2025 performance review for two of the biggest decentralized networks out there, Ethereum and Solana.
Objective, data-driven insights. We're looking at how these complex networks are actually operating and, critically, how value flows through them to their respective tokens.
Right.
We've sifted through a lot of on-chain data, primarily from the DeFi report, and we've cross-referenced it with other leading providers like Dune Analytics, Glassnode, and Token Terminal.
And this is all public data, right?
Absolutely. Remember, this data is public, transparent. We're just here to help you make sense of it all.
Okay, let's unpack this then. Our focus is really on the raw numbers, the on-chain activity, the strategic shifts that, truly define their performance this quarter.
Yep. We'll be looking at everything from transaction fees, user engagement, to how each network's native token is behaving in this pretty dynamic environment.
All right, let's kick things off with Ethereum. What were the standout stories from Q2? How did its core strategy play out in the numbers?
Well, the defining event for Ethereum in Q2 was undeniably the Pectra upgrade. That landed on May 7th.
Okay.
And this wasn't just, another small update. It was a really crucial step in Ethereum's long-term vision to become this highly modular, scalable network.
And the big impact was?
Dramatically cheaper transactions on its Layer 2 networks, primarily through something called blobs.
Blobs, right.
Yeah, think of blobs as like these highly efficient data packets. They're designed specifically to drastically reduce the cost of moving data between L2s and the main Ethereum chain.
So, okay, transactions are getting cheaper for users on L2s. What does this actually mean for Ethereum's L1 revenue and ultimately for ETH holders? Is there a trade-off happening here?
There absolutely is a trade-off, and it's a strategic one.
Okay.
While Pectra significantly improved the user experience by, slashing those costs, it definitely had a notable impact on Ethereum's direct on-chain revenues.
How big an impact?
Well, the total economic value generated by the network, what we call real economic value, REV, that includes base fees, priority fees, MEV, blob fees, it dropped by a significant 53% from Q1.
Wow, 53%.
Yeah, landing at about $144.8 million. And this dramatic reduction wasn't an accident. It was largely driven by a sharp decrease in base fees and blob fees as those transaction costs effectively migrated to Layer 2s.
So the L1 is essentially subsidizing the L2s.
That's a good way to put it. Ethereum's L1 is essentially subsidizing cheaper L2 transactions to really prioritize user adoption and overall network scalability. It's a long-term play.
That's a bold move. So if the Layer 1 is subsidizing transactions, where are the users actually going? Are they flocking to these cheaper Layer 2s as intended?
Oh, yeah. And here's where it gets really interesting. The user migration to Layer 2s, L2s, is in full swing.
Okay.
Combined active users on L2s reached almost 2 million per day in Q2. That's up a solid 17% from Q1.
2 million daily active users.
Yep. And some projects saw massive growth, like Enoshain saw 438% growth, Base was up 26%.
Wow.
To give you some perspective, L2s now drive 5 times the daily active users compared to the Layer 1 itself.
5 times.
And on top of that, L2s process an average of 16.9 million transactions per day. That's an astonishing 12.7 times higher than L1.
12.7x, that's huge.
It is. Again, Unichain was a big driver, up 440%, WorldChain up 60%, StarkNet up 50%. The activity is just exploding there.
And the cost for those users on the L2s, you said it dropped.
Dramatically. The average L2 transaction fee for users was just about 1.5 cents.
1.5.
Yeah, 50% drop from Q1 thanks to Pectra and EIP 4844. This incredibly low cost is acting like a massive stimulus, for the whole L2 economy.
And are the L2s themselves making money?
They are proving highly profitable. Take Base, for example. It's showing a nearly 97% on-chain margin.
97%.
Meaning it keeps almost all the user fees it collects after paying its rent, so to speak, back to the Layer 1.
Okay, so we're seeing lower fees and revenue on the main Ethereum chain, the L1, but this explosive growth and profitability happening on its Layer 2s. How does this strategic shift impact the ETH token itself, particularly its narrative as, a store of value?
Right. The tokenomics definitely reflect this evolving dynamic. ETH issuance, for instance, was actually up 2% in Q2.
Up. Why?
Mainly because the amount of ETH staked increased by 4%. People are staking more. Staked ETH reached an all-time high of 35.6 million ETH.
Wow.
Which is almost 30%, 29.5% to be precise, of the total circulating supply.
Okay, so more staking, slightly higher issuance. What about the burn?
That's the other side of the coin. ETH burned, which comes directly from those base fees on L1, it fell sharply. down 55% to about 21,351 ETH.
And that's a direct consequence of Petra.
Exactly. Lower L1 fees mean less ETH burned. This reduced burn rate meant the circulating supply saw a slight increase overall, about 0.18%.
Okay, so slight inflation overall. What about for people just holding ETH, not staking?
Yeah, this is important. For non-staked ETH holders, the annual net dilution rate rose to 0.73%. That's up 64% from Q1.
0.73% annualized dilution.
It's not huge, but it begs the question. If you're holding ETH and you're not staking it, you're experiencing a small but growing amount of dilution. Staking becomes more important.
That's a critical point for passive holders, definitely.
Huh.
But despite these internal shifts, these tokenomic changes, what about ETH's broader appeal, like as a store of value, institutional adoption? Is that still strong?
It seems so. Despite the on-chain revenue adjustments on L1, ETH showed strengthening as a store of value in other areas.
Like the ETFs.
Exactly. ETH ETF assets under management, or AUM, rose 20%. Significantly driven by Fidelity, actually.
Interesting.
And corporate treasuries now hold about 1.119 million ETH across 48 different entities. We're seeing names like SharpLink Gaming, Bit Digital putting ETH on their balance sheets.
Okay.
And perhaps most telling, the amount of ETH held on centralized exchanges dropped again. It's at its lowest level since July 2016.
Wow, 2016 level. So where's it going?
It suggests capital is rotating out of exchanges and likely into those ETFs and into staking for long-term holding rather than being held for, immediate sale.
That paints a pretty bullish picture for long-term holding. Beyond the token itself, what does this tell us about the overall health and activity within the broader Ethereum ecosystem?
Well, if we look at the Ethereum L1 GDP, which we measure by fees generated by the top 108 applications on the mainnet, that was $1.7 billion, but it was down 15%.
Down 15%.
Which sounds bad, but it actually indicates the network is scaling as planned. It's pushing activity to the L2s to create that better user experience, even if it means less direct value accrual to the L1 in the short term.
So the GDP metric reflects the shift to L2s. What about other areas like RWAs?
Crucially, real-world assets, RWAs, on Ethereum totaled $7.5 billion, and that's excluding stablecoins. That represents a 48% increase quarter over quarter.
48% growth in RWAs. What's driving that?
Largely U.S. Treasuries, they were up 58%. Commodities up 24%, alternative assets up 40%, so real traction there.
Yeah.
Ethereum's total value locked, TVL, also rose 33% to $63.4 billion, although that was partly helped by a 30% increase in ETH's price during the quarter.
Right, price.
Active loans hit an all-time high of $23.9 billion, up 43%. Maple Finance saw a massive 291% surge. This signals really robust professional and institutional DeFi activity continuing to build on Ethereum.
Okay, so putting it all together for Ethereum, it really sounds like they're strategically investing in user experience and scalability via L2s, even if it means that temporary dip in direct Layer 1 revenue.
That's the picture. It's essentially subsidizing cheaper transactions through its L2s, and ETH itself seems to be finding its strength more as that secure, long-term store of value for this vast, expanding ecosystem.
Fascinating strategy. All right, let's pivot now. Let's talk about Solana. Q1 was record-breaking for Solana. I mean, it was just absolutely on fire. How did Q2 stack up for the network known for its blistering speed and efficiency?
Yeah, Q1 was huge for Solana. Q2, in contrast, was largely a cooling off period.
Okay, cool enough.
Unlike Ethereum's sort of strategic realignment, Solana saw most of its on-chain economics and transaction volumes experience declines from those Q1 peaks.
How much decline? What about its revenue?
Its real economic value, REV, generated was $271 million. Still a big number, but down a significant 67% from Q1.
67% down. Wow. What drove that revenue in Q2?
This is where it's really fascinating and different from Ethereum. MEV tips, often called JITO tips on Solana, that's maximal extractable value captured by validators, made up the majority, 55% of this revenue.
Over half from MEV.
Yeah. With priority fees contributing another 35%, this heavy reliance on MEV is a key difference from Ethereum, where MEV plays a smaller role in the overall revenue pie.
That reliance on MEV and priority fees definitely sounds like a different model. You also mentioned its famed efficiency. Did the slowdown impact that aspect?
It did. Solana prides itself on efficiency, but some key metrics dipped in Q2.
Such as?
DeFi velocity. This basically measures how quickly capital is turning over on decentralized exchanges. It fell 42% to about zero point 0.4.
So zero point 0.4 means?
It means roughly 40% of Solana's total value locked, TVL, was turning over daily, which is still active, don't get me wrong, but it's a step down from Q1 where it often exceeded 1, meaning over 100% turnover daily.
Okay, so less churn.
Yes. Similarly, stablecoin velocity dropped 46%, and even the total stablecoin supply on Solana fell 14%. That suggests reduced transactional demand overall. And perhaps most interestingly, the cost to produce $1 of real economic value rose 70%.
Ouch. So it got more expensive to generate revenue.
Exactly. It indicates lower capital efficiency in Q2 compared to Q1. The network had to work harder, essentially, for each dollar of REV generated from its activity.
So a general slowdown across the board there. How did this cooling off specifically impact the SOL token itself? What about its tokenomics?
The SOL tokenomics saw some pretty significant changes as well. SOL issuance, interestingly, was down 4.9%.
Yeah, why is that?
Unlike Ethereum, Solana's issuance follows a set disinflationary schedule. It declines by about 8% annually towards a long-term target of 1.5%, and it's not directly tied to the amount of SOL staked. It just follows its schedule.
Okay, predictable issuance reduction. What about the burn side?
That's where things got really dramatic. SOL burned. It collapsed, down 88% to only 83,803 SOL for the whole quarter.
Collapsed. 88% down. Why such a huge drop?
This was due to a specific protocol upgrade, SIMD 96, which went live back in February 2025. This change shifted 100% of priority fees directly to validators.
Ah, so validators get it all now.
Yep. Previously, 50% of those priority fees were burned. So this change significantly reduced the burn mechanism for SOL.
Wow, that's a huge shift in the burn mechanism, essentially turning it off for priority fees.
Yeah.
What does that mean for the circulating supply and, existing SOL holders?
Dilution.
Exactly. The circulating supply increased by 4% in Q2. Now, this wasn't just due to the scheduled issuance. A significant factor was the ongoing FTX estate unlocks.
Right, the FTX bankruptcy.
Yeah, these involve previously locked SOL tokens hitting the market, which adds a dilutive effect for all existing SOL holders.
So issuance plus unlocks, what's the net effect on someone just holding SOL?
As a result, for non-staked SOL holders, the annualized net dilution rate rose to a pretty notable 5.2%.
5.2%, that's quite high compared to Ethereum's 0.73%. It is, and it leads to a really critical point for holders. If you're holding SOL and you are not staking it, you're experiencing substantial dilution. Staking is absolutely key on Solana to offset this and earn your share of the network's rewards, including those MEV tips.
That's a very important takeaway for SOL holders. So, despite the slowdown and these changes in tokenomics, what about overall activity and adoption for Solana? Is it still attracting users? Is the ecosystem still growing?
Oh, absolutely. It's important to keep perspective. Daily active addresses averaged 4.7 million per day.
Still 4.7 million.
Yeah, it was down 11% from Q1's peak, but let's remember the long-term growth trend remains very positive, and 4.7 million daily users is still a massive number.
Right.
What caused the dip then?
The dip was largely attributed to less speculative activity, particularly around, new token launches on platforms like Pump.Fun, which just had an absolutely enormous Q1. Things cooled off there.
Okay, less meme coin frenzy perhaps. What about other areas? RWAs.
Staking.
Solana's real-world assets, RWAs, also increased, up 24% to $390 million, primarily in U.S. treasuries. So growth there, albeit from a smaller base than Ethereum. Staked SOL reached 390 million SOL. That's nearing all-time highs and represents almost two-thirds, 64.7% of the total supply being staked.
Two-thirds staked. That's huge participation.
It is. And interestingly, a significant 96.6% of the staked SOL is with Jito validators.
Which tells you.
It highlights that strong desire from stakers to access those MEV tips we talked about. That's a major incentive.
Right. And TVL.
Finally, total value locked, TVL, grew 30% to $8.6 billion. Again, aided somewhat by a 24% increase in SRO's price during the quarter.
Okay. So summing up Solana for Q2, it sounds like a reset after a super hot Q1. Less speculative frenzy, some metrics cooled off, significant changes to the burn mechanism leading to higher dilution for non-stakers, but still very high user engagement, massive staking participation driven by MEV, and continued growth in TVL and RWAs.
That's a good summary. A reset, with staking remaining absolutely critical for holders.
All right, now for the really fun part, the head-to-head comparison. We've looked at their individual performances in Q2. How do these two giants really stack up against each other? I know you have that analogy that really helps clarify their core philosophies.
That's right. If we think about their core design philosophies, their sort of architectural approach, it really helps. Think of it like Solana is Apple and Ethereum is Windows.
Okay, Apple versus Windows. Explain that.
So Solana, Apple, it's designed as an all-in-one vertically integrated chain. There are no layer twos in the same sense as Ethereum has. Its focus is relentlessly on the retail user experience.
Smooth, easy to use.
Exactly. High throughput, low cost, a seamless app-like feel. It's built for fast DeFi, meme coins, the everyday retail trader. It aims for that true plug-and-play experience.
Got it. And Ethereum is Windows.
Ethereum Windows. It's a modular, customizable stack that intentionally scales via layer twos. That's part of the design. Its focus is more on institutional trust, maximum security, and deep protocol composability.
More building blocks.
Yeah, it's built for builders, for enterprises, for these complex roll-up ecosystems. It's like an open-ended system that can be extended with all sorts of different technologies, these L2s being the prime example.
That Apple Windows analogy really does clarify the architectural differences and strategic aims. Okay, now let's put their Q2 numbers side by side using that lens. Who won in what specific areas, and what does that tell us about how their strategies are actually playing out?
All right, let's run through the key head-to-head metrics for Q2 2025. First, real economic value, REV. Solana's $271 million, even though it was down 67%, was still significantly higher than Ethereum's $144.8 million, which was down 53%.
So Solana captured more direct revenue.
Correct. It shows Solana's integrated design, for now at least, can capture more direct revenue from the activity on its chain. Solana wins here.
Okay, next.
Burn tokens. Ethereum burned 21.3K ETH. Down 55%, yes, but importantly, it still burns tokens as part of its core mechanism, contributing to its deflationary or low inflationary narrative.
Whereas
Solana's burn collapsed 88% to just 84K SOL, mainly because of that protocol upgrade shifting priority fees away from the burn. This highlights Ethereum's stronger long-term store of value mechanics, at least regarding burn. Ethereum wins.
All right. What about yield for holders?
Real on-chain yield. This is yield from fees and MEV, not issuance. Ethereum came in at 0.4% APY. Solana was higher at 1% APY, mostly from those MEV tips. Solana wins.
Okay, Solana wins on real yield. What about total yield, including inflation?
Total yield, including issuance. Solana's 7.9% APY was nominally higher than Ethereum's roughly 3.22% APY.
So Solana wins again.
Nominally, yes. But, and this is a big but, it's crucial to note that Solana's higher total yield is largely driven by its early.
Okay, how about staking participation itself?
Percentage staked? Solana had a much higher percentage of its supply staked, around 66%, almost two-thirds, compared to Ethereum's roughly 29%.
So way more people staking on Solana.
Yep. Indicates a stronger incentive structure, or at least higher adoption for staking on Solana currently. Solana wins.
Users. Who had more daily active users?
Daily active users. Solana's 4.7 million daily active users far outpaced Ethereum's roughly 400K. And remember, most of Ethereum's users were actually on L2s, not L1.
So for direct L1 engagement, Solana's way ahead.
Yeah, showcases Solana's strength in direct user acquisition and raw activity numbers. Solana wins.
What about the money locked in DeFi?
TVL.
Total value lock, TVL. Ethereum, with $63.4 billion, had significantly more capital depth and established DeFi protocols than Solana's $8.6 billion, much larger ecosystem value. Ethereum wins.
Real-world assets, RWAs.
Real-world assets, RWAs. Ethereum's $7.5 billion in RWAs just dwarfs Solana's $390 million. Big difference there, too.
Demonstrates Ethereum's much stronger penetration into traditional finance and asset tokenization so far. Ethereum wins.
And institutional adoption. ETFs, treasuries.
Institutional adoption. Ethereum clearly leads here. You've got the ETH ETFs, significant corporate treasury holdings we mentioned, its established role as a smart contract store of value. Solana has some light corporate treasuries, but no ETFs yet. Ethereum wins.
One more MEV. Who's capturing more?
MEV extraction. 55% of Solana's total REV came directly from MEV, compared to only 29% for Ethereum.
So Solana's design is better at pulling MEV.
It seems its design is more effective at capturing MEV as a direct revenue source for its validators, who then share it with stakers via things like Jito. Solana wins.
Okay, wow, that's a really fascinating side-by-side breakdown. It truly highlights how differently these two networks are built, how their strategies are playing out in the numbers, and where their respective strengths lie right now. So what's the strategic verdict from all these numbers? If you had to distill it down, what's the core message here for someone trying to understand these two giants?
I think the core message is that both networks are successfully executing on distinct, almost opposite strategies. They aren't really trying to be the same thing.
Okay, so what are those distinct strengths based on Q2?
Well, Solana's strengths. It's clearly optimized for raw user growth, that seamless user experience, and very efficient MEV extraction. It offers that all-in-one, Apple-like simplicity without the L2 fragmentation you see elsewhere.
Which drives?
It drives significant speculation, new token launches, especially appealing to retail users. And as we saw, it offers higher nominal total yield and has that much higher staked supply percentage.
And Ethereum's strengths in Q2.
Ethereum's strengths, it really shines in sustainable economics. Lower issuance, a growing, albeit currently lower, real yield from fees, and that steady burn mechanism.
Better for passive holders.
Much better for passive holders due to that significantly lower dilution. Plus, it has a strong and expanding institutional narrative. It boasts that powerful L2 growth engine, which is now handling most users and transactions, and it dominates in RWAs and total value locked. Its store of value narrative is arguably stronger and growing.
It truly sounds like Solana is the powerhouse for immediate execution, simplicity, and network velocity, especially geared towards attracting and retaining retail users and capturing MEV.
Right.
Meanwhile, Ethereum.
You have Ethereum betting big on modularity and user experience via L2s, even if it means those short-term revenue trade-offs for the L1 itself. The L2s are bearing the brunt of the activity now.
And Solana.
Solana, on the other hand, is pushing for sheer throughput and that integrated simplicity. It's driving incredibly high user engagement and staking participation, but it's facing new questions around its burn mechanism changes and the resulting increase in dilution for non-staked holders.
So for you, the listener, the learner, this isn't just about looking at the price charts. It's about understanding these underlying economics, these strategic choices, and what kind of network you fundamentally want to align with or invest in or build on.
Exactly. Do you prioritize that maximum user activity, the fast, cheap transactions on a single integrated chain like Solana offers?
Right.
Or do you value a more robust, institutionally adopted, less dilutive, long-term asset like Ethereum, which scales through this vibrant, arguably more complex ecosystem of layer 2s? Different value propositions.
Absolutely. And you mentioned AI earlier, briefly.
Yeah, economics for either chain. But both ecosystems anticipate significant future growth in this area as on-chain agents and AI applications become more sophisticated and integrate with blockchains.
Well, what a deep dive this has been. We've really peeled back the layers on Ethereum and Solana's Q2 2025 performance, exploring their unique strategies, their strengths, their weaknesses, and the hard numbers that tell the story.
Yeah, and hopefully this discussion helps you understand that, knowledge is really most valuable when it's understood and applied. There's always more to learn. And considering multiple perspectives, especially when you look at the raw data, it really enriches your understanding in this world of, frankly, information overload.
Totally agree. We've seen how Ethereum's calculated move to subsidize L2 growth is fostering this huge, profitable ecosystem, even at the cost of L1 revenue for now. While Solana's integrated approach prioritizes that high velocity and direct user engagement, even with those recent significant changes to its burn mechanism and the clear implications for dilution.
And looking ahead, maybe the provocative thought to leave people with is this. How will these distinct, maybe even opposing strategies, Ethereum's patient, modular scaling versus Solana's all-in-one high-velocity approach, how will they ultimately impact their long-term value accrual, not just network usage, but value accrual back to the actual token holders?
That's the billion-dollar question, isn't it? Something for everyone to mull over and explore on their own.
Definitely.
If you want to dive even deeper into the raw data yourself, you can access the full Q2 ETH and SOL reports that form the basis of our chat at thedefireport.io.
And all the data, the charts we discussed, they're also available on public Dune dashboards. Just search for ETH report or SSLL report on Dune Analytics.
Perfect. And mark your calendars because we'll be back around October 15th to break down the Q3 reports for both networks. Thank you so much for joining us on this deep dive.